So you want to know if you can actually afford to own a piece of the container shipping business. Not the fantasy version, where you picture a massive vessel loaded with thousands of boxes gliding into port while money quietly stacks up in your account. The real version, the one where the ship itself is genuinely the smaller half of the bill, and the fuel, crew, insurance, and maintenance keep running whether that ship is earning freight or sitting idle at anchor. Subscribe before we start, because by the end of this you'll know exactly what it costs to own a container ship. From the purchase price, to the daily operating burn rate, to the revenue swings that make this one of the most volatile businesses we've ever broken down. And you'll understand why the real skill in this industry isn't buying the ship, it's surviving the years when freight rates collapse. Let's start with the number that determines which tier of this business you're even able to enter, the purchase price of the vessel itself. At the small end, a coastal freighter handling short regional routes and inter-island trade, carrying under 5,000 deadweight tonnage, can be bought used for somewhere between $400,000 and $1.5 million, with a newer small vessel climbing toward $5 million depending on cargo handling equipment and hull condition. Step up to the workhorse tier of the industry, mid-size container ships carrying somewhere between 1,000 and 5,000 TEU, the standard unit for a 20-foot container, and a new build from a shipyard runs between $25 and $55 million, while a second-hand hull, aged 10 to 20 years, can be picked up for $5 to $15 million. And at the very top of the market, the ultra-large container vessels, capable of carrying upwards of 24,000 TEU in a single voyage. A newly built flagship megaship routinely commands a market valuation exceeding $200 million, putting that tier of ownership firmly in the territory of major shipping conglomerates, rather than individual buyers. Now let's talk about what actually drives that price up or down within any given size class, because the second-hand market here works differently than most people assume. Recent 2026 data shows 5-year-old container ships trading at roughly 80% of the equivalent newbuilding price, the highest relative level since late 2022, with used values up around 17% year over year, even as freight rates themselves have softened, meaning buyers purchasing a relatively young second-hand vessel are effectively paying near-new ship money for a hull that's already 5 years into its class cycle and built to an older efficiency standard. Older vessels in the 12 to 20-year range offer a real discount, with 1,000 to 5,000 TEU ships changing hands around $5 to $15 million, but industry analysts are blunt about what that discount actually represents. It's compensation for the real mechanical and regulatory risk that comes with an aging hull, not a bargain quietly sitting on the table, waiting for a smart buyer to find it. Here's where it gets structurally different from almost every other business we've covered in this series. Because the ship purchase price is genuinely just the entry fee, and the operating costs run every single day the vessel exists, whether or not it's earning $1 of freight revenue. Industry cost breakdowns define this clearly, separating operating costs, the day-to-day expenses required to keep a vessel in safe trading condition, from voyage costs, like fuel and port charges, that rise and fall with each individual trip, and both categories have been under sustained upward pressure since 2022, driven primarily by rising crew wages, insurance premiums, and repair costs. One detailed maritime investment breakdown puts annual operating costs on a mid-size vessel at approximately $2.5 million, and separate data on large bulk carriers puts daily operating costs upward of $5,000, which annualizes to somewhere around $1.8 million a year in crew, insurance, hull and machinery coverage, and routine maintenance alone, numbers that keep accruing whether the ship is loaded and sailing or tied up at a berth waiting for cargo. So what does the revenue side actually look like, and does it justify numbers this large? This is genuinely the most volatile part of the entire business, and the freight rate swings involved are dramatic even by the standards of commodity-driven industries. Before the pandemic, the average freight rate for a standard 40-foot container sat around $1,450, and by September of 2021, amid unprecedented global supply chain chaos, that same box was commanding over $10,000. Rates have come down considerably since that peak, with the Drewry World Container Index putting the global average around $4,300 for a 40-foot container as of August 2026, though forecasts for the year ahead show real uncertainty, with baseline predictions calling for rates as low as $2,200 to $3,200 in calm periods, and sudden shocks like Red Sea disruptions or a wave of restocking capable of pushing spot prices above $9,500 within a matter of weeks. For a shipowner, that volatility is the entire ballgame, since the difference between a strong freight market and a weak one can swing annual revenue by a factor of 3 or 4 on the exact same vessel running the exact same route. Now for the stuff nobody warns you about before you start pricing out a vessel. First, financing structure matters enormously here, and one detailed maritime investment analysis modeling a vessel purchased with 60% debt financing found that after covering roughly $2.5 million in annual operating costs, plus debt service, net return on equity ranged between 12 and 22% in strong freight markets. A genuinely attractive return, but one entirely contingent on freight rates staying elevated, meaning that same structure can turn deeply negative the moment rates fall toward the softer end of their historical range. Second, the industry has opened up in a way that didn't exist a decade ago, with fractional ship ownership platforms now allowing retail investors to own a share of a working cargo vessel for a fraction of what full ownership requires, and historical data from these platforms suggests annualized returns between 8 and 18%, depending on vessel type and market conditions. With tankers and bulk carriers historically offering the strongest yields, though every one of those platforms is careful to note that past performance during a period of elevated rates is not a guarantee of future income once the cycle turns. Third, global fleet capacity itself is a headwind worth understanding, since the container ship fleet is projected to grow by roughly 5% in 2026 alone, and the bulk of that new capacity is headed towards secondary trade routes in Africa, Latin America, and South Asia, rather than the major Asia-Europe and Asia-US lanes, meaning oversupply pressure is building even as demand on the busiest routes remains comparatively tight. Fourth, regulatory costs are a real and growing line item that didn't exist in this form a few years ago, with emissions trading schemes and international carbon intensity requirements now functioning as direct operating costs and routing constraints, meaning owners increasingly have to factor environmental compliance into the same spreadsheet as fuel and crew wages rather than treating it as a separate regulatory afterthought. So who's actually winning at this? Overwhelmingly, it's owners who lock in long-term charter contracts with shippers rather than relying entirely on the spot market, since a multi-year charter at a fixed rate insulates an owner from exactly the kind of freight rate collapse that can turn a strong market vessel into a money-losing one within a single quarter. It's also owners who time their vessel purchases against the freight cycle itself, buying second-hand tonnage when rates and asset values are depressed, rather than paying near new-build prices during a boom, and owners who keep utilization high by minimizing idle time between charters, since a vessel sitting at anchor waiting for its next cargo commitment is still burning through that daily operating cost, with zero revenue coming in to offset it. How do people actually lose money on this, or badly underperform the returns above? Almost nobody loses money because the ship itself was mechanically unsound or poorly built. They lose money because they bought at the top of a freight rate cycle, paying near new-build prices for a vessel, just as global fleet capacity was expanding faster than cargo demand, and then found themselves locked into debt service, calculated against boom-era revenue assumptions, right as spot rates reverted back toward their long-run average. A pattern that has repeated itself across multiple shipping cycles over the past 2 decades, and shows no sign of becoming any less brutal in this one. Okay, so let's put the real numbers side by side. A conservative buyer purchasing an older, 12 to 20-year-old mid-size vessel around $8 million, financing a portion of it, and budgeting for roughly $2 to $2.5 million in annual operating costs, is exposed to the full volatility of spot market freight rates, meaning a strong year with rates near the higher end of the current range can produce a genuinely attractive return on equity, while a soft year with rates compressed toward the lower end of 2026 forecasts can turn that same vessel cash flow negative once debt service is included. Now the stronger version, an owner purchasing a similar vessel but securing a multi-year charter contract with a stable shipping line before ever taking delivery, locking in predictable revenue against that same operating cost base, is insulated from a meaningful share of that volatility and can realistically target the 12 to 22% return on equity range that strong market modeling suggests, precisely because the revenue side of the equation no longer resets every single week with the spot market. So yeah, can you actually afford to own a container shipping business? If the question is whether you can write a check somewhere between $5 million and $50 million depending on vessel size, that number alone puts full ownership out of reach for the overwhelming majority of people who've ever found this industry fascinating from the outside, though fractional platforms have genuinely opened a smaller dollar entry point for anyone willing to accept the same underlying volatility on a smaller scale. The real test isn't whether you can afford the vessel itself, it's whether you can survive the operating costs that run every single day regardless of freight revenue, and whether you've structured your financing and your charter contracts to withstand a rate cycle that has swung by a factor of 7 within the past 5 years alone. The owners who make this work aren't the ones who simply bought a ship at the right price. They're the ones who understood, before they ever took delivery, that they were buying into one of the most cyclical, capital-intensive businesses in the entire global economy, not a steady stream of freight checks with a boat attached. Subscribe, and we'll do this again next week with the next opportunity that costs more than the sticker price ever tells you.